Hey everyone, welcome to the webinar today for why about mortgage drip campaigns. My name is William LeBaron. I'm the VP of Business Development here at MonitorBase, and I actually have Louis Zitting on the call as well. Louis, can you hear me?
I can. Can you hear me?
Yes. All right. System appears to be working so far. I'm going to do a quick unofficial poll for those of you attending the webinar. Can I get some quick hand raises that the system's working? You should be able to see my webcam and hear my voice. Awesome. Thank you, Jennifer. Thanks, Beth. Thanks, David. Daniel, awesome. Hey, thank you guys. It's always nice to not monologue for 5 minutes before I get a question that says, hey, I noticed on the webcam you're talking, but I can't hear you. So, all right, jumping into a little bit of context for today's webinar. You may have responded to, I think there was a Facebook ad. We had some promotion to our current database of users and people in our CRM. The topic of today's webinar is why mortgage drip campaigns can and often do more harm than good, and some of what to do about it. We want to try and tie this into a message that you guys will find useful based on the insights that we have. MonitorBase has over 9 million prospects in our database that we monitor on a regular basis. We've worked with a lot of originators, and our goal is to turn this into a little bit of a roundtable discussion and pull in as many of the questions from the audience side as we can on the topic. So anything off the fly that you want to see included in our discussion today, please type those into the questions tab. We have a couple of people helping manage that questions tab, and we'll try and keep up on that and integrate that for everyone's discussion. Using the technologies that we have and the integrations we have some really interesting data points I want to go over. And we're going to try and distill that in the end of this presentation into some do's and some don'ts. But before I get into the data, we actually get kind of an unexpected insight into this particular problem. We at MonitorBase have worked with over 10,000 originators. I think that's pretty fair to say. That's about the amount of email addresses in our MonitorBase software, not just like our CRM of people we've worked with, but actual user accounts in the system. And interestingly, when you have 10,000 loan originators and their email accounts and our system communicates with them, we end up in a lot of marketing lists. And so we see a lot of the drip campaigns, a lot of the marketing that goes out from these originators. And it's kind of an unforeseen consequence and I guess anecdotal evidence that we get that may actually be the reason for this whole the initial blog and then this webinar, because we're seeing what you are sending people, and we're seeing the messages being I want to say just indiscriminately blasted at an email contact list. We're getting the message because we emailed you, and because we emailed you, now you're going to market to us, I guess. So here's the problem that can cause, and we're going to delve into that and pull some of the data into it. But it starts when you send someone who is listening to you. I mean, you have a data set of people who know you and trust you, and when you take that group of people and you send them a message, and they're listening, it could be a past customer, a friend, an old prospect, that didn't get a mortgage, but you send them some indiscriminate mortgage-related information. Interesting to you maybe, but not like super interesting to them. It's just self-promotional. The day after that, maybe as an example, going back to that past funded client, you send that out the day after they fund or the week after they fund. The last thing that I want as someone who just closed a loan is to go out and start the loan process again. And even if I wanted to, I don't really need to. And you're sending me a market update for a service that I don't really need. And the traditional campaign that we're seeing out of our user set is about the loan originator. It's not about the customer, and the timing on it and the audience selection is not particularly great. So even I want to highlight here that the consequence of that kind of marketing it can be devastating. And I'm not talking about people marking your emails as spam and then your delivery going down. Or blocking your phone number. It doesn't take a client blocking your phone calls or marking your emails as spam to cause this issue. They just have to not pay attention enough times in a row, and you'll start to see the consequences of that of that ignoring stack up. And I'm going to walk you kind of through it with what we see in the data, particularly in the database or the client retention category. You get some really intriguing insights into this problem. So you guys maybe, if you've been a part of our audience for a while or one of our users, you've probably heard the statistic. About 1.5% of your database is entering the mortgage market every month. About 20% of them return to their last loan originator. You do see about 80% go close their very next loan with someone else, and that statistic should kind of demonstrate the problem or the scope of the lost opportunity in this whole client retention realm. And when it comes to going back to that first statistic, if 1.5% of your database enters the mortgage market every month, and let's say the average loan cycle is 60 days, you're only talking about 3% of your data set of any group of people actually being in the market for a mortgage, where 97% aren't. Now, maybe those numbers aren't particularly perfect. Maybe 5% of your database is in the market for a mortgage at any given moment, and 95% isn't. But regardless, you can kind of see the point here. There's a big set of people that if you market them, your marketing message is saying, hey, I know you are not looking for a mortgage. Let me try and talk you into getting a mortgage. And then there's a very small percentage that your marketing message says you're in the market for a mortgage, and I'm talking you into being in the market for a mortgage with me. And there's value in trying to do that differentiation and finding the right set of people to talk to. And the message that we want to highlight today is not about how to find the right set of people. I want to talk about the consequences of talking to the wrong set of people, sending the wrong message for too long. Because each time I send an email to you, and any of you who have a Gmail account, each time I send an email to you, and that email goes unopened, it's not just, oh, I didn't get a good response on that email. You've trained Gmail that messages from me to you are not relevant. They're not useful. And Gmail starts to sort those from your standard folder, maybe over to that promotional folder. And in time of having your emails automatically go to the promotional folder, it will eventually end up in the junk folder, because something that gets ignored, Gmail and every other email service out there is paying attention to how you're interacting. And the longer those messages get ignored, the more often that something goes really that isn't interacted with in any kind of meaningful way, the less likely it is that Gmail will think you'll ever pay attention to that email, and the more they'll deprioritize it until eventually it just no longer even arrives in your inbox in any way. And that's the real danger here, because we're not talking about you sending campaigns and people blocking your phone calls. We're talking about you being able to train your audience's technologies to simply ignore you completely. So even if your message is timely in the future, the more often you're marketing this person right now when they're not, the less likely you are to be able to get that loan later. So,
and let me jump in there. The real issue that creates isn't just that somebody's ignoring you, but you know, when you're engaging with people recently after a funded loan, and then they start ignoring you over the next year, you're losing out on the opportunity of when they are back in the market that they actually will open and look at your email. Where if they haven't seen anything from you for months until, for whatever reason, you know, they're back in the market, they're ready to do some sort of refinance, or you know, they're thinking about listing their home. If you have an indicator to that and you reach out then, and they haven't seen your name over and over and over, they're much more likely to open that. So that's kind of the issue. We don't want to wear out this audience or desensitize them to your name or brand, so that when the important time comes that they actually are back in the market, then they'll open that email or mail piece. The marketing that you do isn't gonna convince somebody that it's time to do a mortgage. It's really, you know, the more you can be timely and have some good intel onto, you know, when are these people going to be back in the market, and then that's when you start your workflows.
Right, and it actually, this segues really well into my next section here. I think it was Experian that told us recently, Louis, this year, the average like life cycle of a mortgage customer is they purchase and then they refinance twice and then they purchase within an 8-year window. So you're seeing a purchase, refi, purchase cycle that is happening. And oftentimes there is this loan originator helps with the purchase transaction, and then they miss out on this next transaction. And going back, it's a vast majority. You're only retaining about 20% of this data set by the time they get their very next loan. But when you miss out on the next transaction, that refinance, it's lost revenue, and that's tragic. But it also means that you're less and less likely as the time goes on to catch these future transactions because they have a new loan originator or a new mortgage company that they are working with. And I want to kind of focus on some first-time home buyer behavior for a moment. Just some quick data points that I think are relevant to explain. When it comes to mortgage marketing, you do need workflows, and you need those workflows, I would say, to be intelligent, based on what kind of person you're talking to. It's not about taking your whole data set and blasting them with emails every other week, because really quickly that just stops working. The average first-time home buyer, they represent about 47% of the purchase market today as first-time home buyers out there shopping. So if you're doing purchase business, it's very close to 1 in 2 of your transactions are a first-time home buyer. And many of these people take more than a year to go from the start of the loan process to the completion. And so there's real value in having automation around follow-up with your current prospects or loans in process and working with these people. And the interesting thing is that's not perfectly relevant to drip marketing, but it kind of is, because this isn't about you taking your current database and finding new opportunities. It's taking your current opportunities, the people that are in your hand, and making sure you're focusing to maintain those through that life cycle. Because if it takes a year to close that loan, you need to have a couple of touch points planned in within that client life cycle for your deals in process, for your prospects. Now, once they've funded, when it comes to drip marketing and how you go through the process of maintaining your data set, you need to be able to differentiate and say, this is how I'm treating prospects, people who started the loan process with me but haven't completed it. And you nurture those through that life cycle. But once you have a funded client, you need to treat them a little differently. And just recognize there's a limitation to the quantity of attention that you're going to maintain from your database. I've maybe focused too much here on emails, because email messages are really good and it's easy to understand. We all kind of recognize the danger of emails. You send an email too often, it gets ignored too long, it ends up in spam folders, and eventually even if they're in the market, you can't reach them. But the same thing goes for someone who you call too often. It goes for someone who posts too much stuff on Facebook that you find is irrelevant about them, maybe a little edgy. And if they filtered and posted half as much stuff on Facebook, maybe you would have stuck around. But for those people who post too often, at least for me, I oftentimes go through and I unfollow those people because they dominate the information that I'm seeing and it's not relevant or interesting to me. And I try and sort down to the stuff that I actually want to see. So I have to filter less on a daily basis. And that's what's happening when you're making these phone calls or you're sending out these postcards, because it's not just training the email systems to ignore you, you're training the customer to ignore you. When you send a postcard every single month talking about interest rates, talking about services, 95% of your customers are just, no questions asked, not in the market for a mortgage. And your message isn't trying to talk them into being, your message is not going to successfully really talk these people into moving from not being in the market into being in the market. And consequently, you're training this person who gets your postcard to kind of throw it away. And enough times throwing it away and they just ignore you completely. I think, Lou, you gave an example of a billboard. A new billboard goes up on your commute to work. You'll notice it the first day. You'll notice it the second week. But by the end of the first month, after you've driven by that billboard 22 times, it's very likely you'll never notice it again. It's just something that becomes part of the background noise that you block out.
Yeah, and I mean, and the real issue is, I mean, you know, marketing has really changed in that we can find leading indicators and serve marketing to people when they're in the market, so that, you know, we don't have to do the old way of billboard marketing. Just be out there for the 100,000 people that see it, and then 5 of them that are in the market might notice it because that's relevant to them at the time. People get so many messages in mail and email that that, you know, they're anything that doesn't catch their eye in the first second, it's not relevant to them at the time, they're going to start to ignore that. They'll start to ignore the you know, the sender. And so I think we've made that point.
Yeah.
We don't want to wear out the audience, so let's talk about some of the solutions. And by the way, I don't want anyone to think that we're saying that email and mail and Facebook doesn't work. Those are great sources for marketing. Email's still wonderful. It's super inexpensive. Direct mail still works, still gets a good response. But it's, you know, when it comes to the timing of it, you can have 5 to 10 times more response if you're just getting to people and being able to identify who might be really in the market and then execute those workflows. So William brought up the first-time home buyer. We heard a stat when we were at a conference at Experian. They said that of consumers that apply for a mortgage for the first time in their life, so first-time home buyer, within 90 days, only 3% of them have completed a mortgage transaction. And after a year, there's still only 9% that completed a transaction. And then it's, you know, it goes up from there. Those people aren't just entering the home buying market and then leaving. They're eventually going to buy a home. And so that is a long process. So that's an example of where, you know, somebody's entered the market, they've showed some intent. Those are the ones that you should do some sort of workflow that continually contacts them, because they may be working on paying off some highest interest rate credit cards, figuring out a down payment, and that's why that big long cycle happens. But we know they're in the market, and so it makes sense to keep in touch with those versus just, you know, anyone in your database that we don't really have an idea of the prior intent or some sort of life event that would tell them, you know, it's really likely that they're going to do a mortgage. And so there's still a lot of value in doing these. It's just, it's rather than doing just blanket marketing, it's good to identify these people are likely in the market. Let's go and do a workflow that's relevant to that.
So yeah, and I agree. I probably labored the point too much. So let's move over from the what not to do category to over some of the insights of what to do. Because being able to create automation in the mortgage industry is just becoming more and more necessary. And so being able to automate, Louis mentioned workflows, but whatever terminology you have within your CRM, it is how you identify who to talk to, and then beginning to talk to those people in a more personalized way. It's not this, you know, high volume fire hose of just hitting all of your audience all the time and hoping a couple of them respond. Because real quick, they're just going to get sick of it and leave. But if you can identify who's actually in the market, find these intent signals and these qualifying candidates, you can double down your efforts on those people, and the message is relevant, and your open rates are better, and they respond to phone calls, and they click those Facebook posts. And so now your marketing dollars are more efficiently being spent. Instead of directing all of your efforts to try and hit 100% of your data set, narrow that down where your efforts are maybe focusing on that 5 or even 10% of your data set who you have some sort of indication or insight is in the market. And there are lots of these insights that you can get. And by focusing from that 90 down to that 10, your marketing dollars go a lot further on a set of people who you have a lot less to talk them into. Again, it's not talking them into entering the market for a mortgage. They're showing they're probably in the market or about to be. Now you just need to talk them into the fact that you're a good deal, because we know they're shopping. And that's fantastically efficient. And if you aren't using some sort of database marketing tool, there are lots of them out there that give you these kinds of indicators. And so I want to kind of go through some of those intent signals, some of these indications that someone is in the market, about to be in the market, and you each deal in a very different environment. I mean, we have a really broad audience today, and some of you may focus on one, and some of these examples don't apply. But if you can find the examples that do apply within your own world, you'll find out that there's an efficient way to probably find that subset of people and start generating business from them. And there's value in that, because not only do you get that immediate gratification and your marketing dollars go further, but you actually preserve your audience. And that's hugely powerful.
Well, and also, besides, desensitizing the consumer, what we're fighting against that we weren't with direct mail. You could direct mail anyone you want anytime, and they may be desensitized to it. But with the internet service providers that host email and Facebook and your retargeting campaigns, you're fighting against algorithms that are very clear on what messages people are engaging with and what ones aren't, and that's going to get shown more to the audience. So we're talking about, rather than the email coming into the inbox, it's going to spam. Well, if they aren't seeing your email often, but when you send timely, relevant emails to people, and Google sees that you have a much higher open rate and much higher engagement rate, that's telling them, okay, we're going to put this one in the inbox rather than promotions or spam. And Facebook, your cost per impression will go down if your ads are relevant and timely and more people engage with them. So we're fighting against the algorithms and trying to game those to where it's all coming down to the better and the more relevant the message is, or and timely, then they're looking at the results of who's clicking, who's engaging.
Right, because Facebook wants their ads to work. Like if you run a Facebook ad campaign, you'll oftentimes see that it'll work really well week 1, and it starts to taper off week 2 and 3, and eventually you wear out your audience. And part of that is the audience stops paying attention. But a bigger part of that is Facebook notices the audience stops paying attention, and they stop serving the ad. And your ad just dies because Facebook sees it's not working, and there are other people that it will work for, and they sell the attention to someone else. It's the same thing here. So these intent signals, when you can operate based off of that, off of actual in the market indicators, you're kind of gaming the system, because now Facebook is seeing a surprisingly high engagement level, and Google is seeing that those Gmails are being opened way more than other instances, and so now your deliverability goes up, your attention goes up, and the algorithms end up working in your favor rather than against you. And I'm going to go through some of these, because like if you're familiar with us, you probably know a client, a past customer, or someone in your database who applies for a loan with a mortgage company is just like a plain obvious intent signal. They're in the market. And most consumers do actually, in the loan process, talk to 2 originators. So there's very, very consistent opportunity in that kind of thing. But that's not just the only place. And you can oftentimes get further upstream of loan applications by looking at things like, as an example, there are rate drops. I don't know, we could probably try and do this as an unofficial poll. Have any of you ever gone through, there's a big rate drop or an MI drop, and you just went through and pulled a report of your past funded loans and called all of those people? Just a quick hand raise, just so we get some interaction out of the poll, out of the group here. See, yeah, quite a few of you are chiming in, and you find that rate change ends up being this huge indication of you can limit it down based on, look at your current rates, what rate did you give them, what MI were they at, and now you call these 20 or 50 or 100 past customers for a branch, you tell them about the new change, and you have a whole new engaged set of people, and they respond so disproportionately in comparison to some other campaign that's a huge indicator of someone that you should be talking to. But there are lots of these things that maybe you hadn't thought about. So we went through and we started making a list. And just this is meant to get your mind thinking about how you can look for intent signals out of your own database. Applying for a loan, a rate drop, an MI drop for FHA deals, people who list their home for sale or for rent. Someone who has a change in employment it's a huge indicator of or predictor of future mortgage shopping behavior, because most people who sell their home and move up, they don't go and double their house size. They actually only move up by about 10%. They gain about 100 square feet and they move up about 10% in the purchase price of their home. So it doesn't take a huge employment change to get that person to go from one house to the next. And there's opportunity in that kind of information. Graduation, I've met several originators who have really intricate marketing campaigns for finding, medical doctors who are graduated and going into the employment field. Changes in family status are giant predictors, having a child or having a child move out. Interestingly, and this is kind of leading into the topic of our next webinar that's going to be next month. We'll send you more information later, but HELOCs are popular because oftentimes it's easier, it's quicker, and clients are not willing to go through the whole work of a mortgage, so they'll go out there and they'll get a HELOC to do maybe a full some sort of debt consolidation, right? Maybe some renovation. The HELOC was the easier option, slightly more expensive rate, but they went with it. But the cool thing after a HELOC, when you maybe go pay off debt or you go renovate your home, is your home value goes up or your credit score goes up, or both. And in that activity,
we're actually seeing this a lot in the data right now, and that's why we wanted to bring it up. There's, a HELOC generally has a little higher credit score requirements, and so some people still go directly the route of a cash out in the beginning, but a full qual cash out and a full appraisal and all the documentation required is so much harder that a lot of people are just going and getting the HELOC because it's so much easier to go in a credit union. They do a drive-by appraisal, they give you your money. Nobody cares what the rate is because they're solving this bigger problem of debt overload, or they want to renovate their house, and they could, the rate doesn't seem like a problem compared to what they're going to fix. But what we're seeing is a lot of times shortly after that, a couple months after, people are going and doing the work of the cash out because now they've improved their credit, or they've got more equity in their house because they redid their kitchen. And so there's this big, influx of intent. It's kind of an intent signal when we see a HELOC that later down the road, those people will go and decide to gather up all the paperwork and do a full appraisal and do a cash out to consolidate that.
Right.
I was looking at the numbers in the FHA refinances this year so far, and surprisingly, 49% are a conventional loan to an FHA refinance. And so, that's not a rate in term, that's not a rate reduction. And so those people are doing that because they have some non-QM mortgage, or they want the cash out. And a lot of the times they're doing a consolidation with a HELOC. In fact, so of the FHA refinances this year, 75% are cash out and only 10% are a streamline refinance, even with the rates coming down as much as they have.
That's crazy. I mean, it makes sense though. It's just we're in a flat rate market for the most part, and that's the trend. And so continuing on this list, we're almost through it. We won't drag you through too many more examples, but just equity appreciation often merits a refinance for a mortgage insurance drop, even if you're not taking any kind of cash out or trying to do renovations. Credit improvement, the exact same thing. Someone who works really hard to improve their credit, get an FHA loan, and they make payments for a year, their credit's going to skyrocket. And now they're possibly into that conventional category. Someone who's retiring, and you're seeing a lot of this with the downsizing market, where retirement merits a smaller house, they're empty nesters, and that can be an indication or a predictor of future shopping behavior. And there's lots of opportunity for the reverse mortgage. I think we're seeing a trend of increased reverses as well. So what we see is we actually see lots of people running successful marketing campaigns on different subsets of this, and this is just blanket marketing campaigns to people maybe in a region, and they make money on it. They figured out efficiently how to generate interest, and they pull closings out of it. But when you market someone in your database where you have a pre-existing relationship, we consistently see 5 to 10 times the response, which means basically you're paying 10 to 20% what these people are paying retail. 5 to 10 times the response means you can pay 1/10 as much to close a loan if you have a pre-existing relationship. And so we're trying to, in highlighting this, use some of the insights we see in the big data marketing world and help you apply those to your database marketing, because using those insights, you get huge results. And you're not talking about gigantic marketing budgets. It really can be a very efficient, targeted, and effective campaign. So to be able to use these indicators, these intent signals, and then utilize the channels we've talked about. We were too negative through the initial thing. We talked about email and how it can hurt, or direct mail or phone calls. But when you use intent signals followed by that, it actually flips the whole thing on its head. Now you get better open rates than average. Now you get better response rates on social media than average. Now people answer your phone calls better than most phone campaigns. And now being above the average improves your overall odds. And it gives you kind of that step ahead of anyone else, because you're taking a more targeted approach. And within that, that's the concept that we wanted to highlight today. As you're going through and executing campaigns, think of how you can bring them in or target them in a more specific way, segment them into categories. And it might be just a little bit of work up front, but we know based on the data that it pays off in the long run, because the alternative is to keep going with a generic kind of shotgun approach. And this shotgun approach eventually wears out the audience, where the audience loses its value, not because they no longer know you or have that relationship, but if the message doesn't get there, you didn't even have an at-bat, you never had a shot at the business. And so by focusing, kind of taking that 100% campaign, try and narrow it down to a 10% campaign. And that 10% campaign, you can put more resources behind it, maybe still use the same 100% budget, but a more effectively targeted version of that, using any number of these intent signals we've identified or talked about today, or anything else. I'm actually curious if you guys are using other intent signals that we didn't think of or we haven't seen. But these kinds of things can really efficientize your marketing, help you set it on autopilot, and have those dollars generate 5 or 10 times the response that you were getting before on a dollar per dollar spend. And that's the value of data in today's world. And it's just so much more accessible than it used to be, with all the tools available and all the automation that you can create. So Louis, I think that covers what we were hoping to go through as far as our list of topics today. And we are holding another webinar next month. It's a similar topic. We have insights into the data. And I mentioned earlier on the HELOC side of things, that webinar is going to be focused on refinances specifically and mining refinance opportunity in a stable rate environment. So it's what the data is saying about how to find these high margin refinance opportunities in the current marketplace, because refinances are happening. And if you're ignoring that, you're leaving money on the table. That registration link will be sent out to you in the follow-up to this webinar. We've also recorded this for the purpose of distribution after this. But I wanted to bring an opportunity up because we're hoping for some interaction here on this next webinar. We do have a lot of data, and we've spit out quite a few statistics and information that we've just been able to derive from the data that we have access to. If you have questions, database questions, you're curious about a number, you want some statistics, let us know. We will see if we can answer those from our data set. We work with Experian, we work with some online repositories, we work with listing data, and within that we actually have some amazing insights, and we can do some calculations and bring those data answers to you. So feel free to email us or type those into the questions tab today. We're hoping to be able to bring some value for those of you who want to show up to that next webinar to identify those, get some more insight into the refinance market that's happening today. Beyond that, anything else, Louis, you want to chime in before we wrap this up and let everyone jump off?
No, just want to say thanks for joining, and same thing, any feedback you can give us. This was kind of the first of a series that we want to do. If some of it we're probably preaching to the choir, and so tell us, hey, this was we knew this, we'd like to hear more about this, then we can tailor that and go pull together some data for the follow-up webinars and hopefully provide some value and give you some actionable real data.
Awesome. All right, thank you all so much. We really appreciate the attendance and attention on today's webinar. Again, William at MonitorBase.com, sales at MonitorBase.com if you have any questions, and we will include that in the next webinar. And you'll get a follow-up email with this recording if you want to pass it on to someone. So feel free to do that and register for that next event. Thanks, everyone. Have a fantastic rest of your week.